1929, Joseph Kennedy stepped out of the market before the crash and made a fortune as stocks collapsed. In 2008, Michael Burry bet against subprime mortgages, and his fund made hundreds of millions when the system broke. And as we are approaching 2026, many of the same early signals are beginning to appear again. There's a pattern in financial history that shows up whenever markets reach extreme valuations. It isn't random, it isn't luck. It's a four-stage sequence that certain types of investors follow with almost mechanical consistency. While ordinary people often hold their positions all the way down, a much smaller group quietly positions themselves months in advance. They don't cause the crashes, but they study risk, they recognize imbalances early, and they prepare for outcomes most people don't see coming. You saw this in 1929, when Kennedy exited near the peak and profited as the market unraveled. You saw it again in 2008, when Burry, John Paulson, and a handful of others made billions betting against the housing bubble. And today, some of the world's most sophisticated investors are taking actions that fit the earliest stages of the same historical pattern. Warren Buffett is holding around $325 billion in cash and short-term investments, the largest cash position in Berkshire Hathaway's history. Jeff Bezos has sold over $13 billion in Amazon stock across 2024 and 2025. Mark Zuckerberg and other major tech insiders have sold billions as their stock prices hit new highs. Certain sectors across corporate America are seeing elevated insider selling compared to typical periods. At the same time, institutional investors are ramping up hedging activity, buying protection that increases in value if markets fall. These behaviors aren't conspiracy, they're documented strategies. And once you understand how this four-stage sequence worked in 1929 and 2008, you'll recognize where many sophisticated investors believe we are in the cycle today. Let me show you the four stages, how they played out in 1929 and 2008, and the moves smart money is making right now as they quietly prepare for what comes next.
Stage 1 is the quiet exit. It usually happens long before the public realizes anything is wrong. This is when sophisticated investors begin reducing risk while markets are still rising, not because they know the exact crash date, but because valuations stop making sense and the upside no longer justifies the risk. You saw this behavior clearly in 1929. Joseph Kennedy, one of the most successful speculators of the era, started selling his positions months before the crash. People often repeat the shoeshine boy story, the idea that Kennedy knew it was time to get out when even a shoeshine boy began giving him stock tips. But here's the simple meaning behind the story. When people who normally have nothing to do with investing start giving confident financial advice, the market is overheated. It means everyone is already in. There's no one left to buy. And that's when bubbles pop. It's the same signal you see today when the taxi driver tells you which stock will 10x, your barber talks about buying gold, Uber drivers recommend crypto coins, your coworker with zero experience becomes a trader, beginner investors speak with absolute confidence, family group chats turn into investment channels. When that happens, the smart money steps back. In 1929, the real signal for Kennedy wasn't the shoeshine boy, it was leverage. Investors were borrowing up to 90% of the money they used to buy stocks. A simple 10% drop would wipe out entire portfolios and trigger forced selling. Kennedy understood that once the decline started, the whole system would collapse under its own weight. So throughout the summer and early fall of 1929, he quietly liquidated his positions. He wasn't alone. Bernard Baruch, another legendary investor who had lived through past financial panics, also moved heavily into cash. By September 1929, both Kennedy and Baruch were largely out of the market. The Dow peaked on September 3rd. The crash began 7 weeks later on Block Thursday. They didn't predict the exact day, they simply recognized the signs, reduced risk early, and exited while the public was still euphoric. That's stage 1.
In 2008, the four-stage pattern didn't disappear. It simply returned with new faces. Michael Burry, a doctor-turned-investor running a small hedge fund called Scion Capital, began studying the housing market in a way almost nobody else did. Instead of listening to banks or TV experts, he went straight to the real numbers, the actual mortgages inside the financial system. And what he found was shocking. Millions of home loans had been given to people who could only afford the first year or two of payments. Some loans didn't even require proof of income. Others had teaser rates that would jump dramatically after 24 months. It was like giving out sports cars to people with no driver's license and then acting surprised when the crashes started. Yet Wall Street was packaging these risky loans together, stamping them with the highest AAA safety rating, and selling them to investors all around the world as if they were nearly risk-free. Burry realized something simple. These loans would fail. Not maybe, not possibly, inevitably. But he couldn't short the housing market directly. There was no button to press, no sell order to place. So he convinced big banks to create a new type of insurance contract, one that would pay out if these mortgages started collapsing.
These contracts were called credit default swaps. Think of it like buying insurance on a house you believe is going to burn down. You pay a small premium every month. If the house burns down, the insurance pays you the full value. Between 2005 and 2006, Burry bought over $1 billion worth of this insurance. He paid the premiums every month, and as long as the housing market stayed strong, he looked completely wrong. His investors were furious. Some tried to pull their money out. But Burry wasn't guessing. He was simply early. John Paulson, another investor studying the same data, came to the same conclusion. Housing prices had risen far beyond what average families could afford. Underwriting standards were collapsing, and the system was starting to creak under its own weight. Paulson created funds specifically designed to bet against the weakest parts of the mortgage market.
He raised capital, bought credit default swaps, and waited. Then the cracks appeared. Defaults began rising in 2007. Mortgage companies started failing. Banks began reporting losses. And by 2008, some of the biggest names on Wall Street were collapsing. Bear Stearns fell in March 2008. Lehman Brothers, one of the oldest financial institutions in America, collapsed in September, triggering the largest bankruptcy in U.S. history. And the insurance contracts Burry and Paulson bought exploded in value exactly the way they were designed to. Burry's fund made hundreds of millions. Paulson's strategy became one of the most profitable trades in financial history. They didn't know the exact month the system would break. They didn't have a crystal ball. They simply recognized stage 1 and stage 2 long before the crowd and positioned themselves before the collapse became obvious. What looked crazy at first became legendary when the dust settled.
Stage 1 is when the smart money quietly steps back. Stage 2 is when they begin buying protection, long before the crowd understands why. In today's markets, that protection usually takes the form of put options, VIX calls, or credit default swaps, tools that increase in value when volatility rises or when certain assets fall in price. They're not glamorous trades. They're insurance, and insurance only pays off if something goes wrong. But this isn't new. In 1929, modern hedging instruments didn't exist, so short selling served a similar purpose. Historical accounts suggest that both Joseph Kennedy and Bernard Baruch, after reducing their long positions, began shorting parts of the market as valuations climbed and margin debts surged. Short sellers pay borrowing costs to maintain those positions, just like paying premiums on insurance. While the market kept rising, they looked early, even wrong. Then Black Thursday hit on October 24, 1929.
The Dow fell sharply, down nearly 30% by the end of the month. By 1932, the market had fallen almost 89% from the peak. Exact numbers aren't documented, but biographers consistently report that Kennedy earned significant profits from his short positions, enough to massively expand his wealth during the crash. In other words, his insurance paid out at the exact moment the world panicked. You see the same pattern in 2008. Michael Burry and John Paulson spent years paying premiums for credit default swaps, insurance on mortgage bonds they believed would fail. For long stretches, their trades looked terrible. Their investors were frustrated. The housing market kept rising. But once defaults finally began to accelerate in 2007 and 2008, the swaps surged in value. These hedges generated hundreds of millions for Burry and billions for Paulson, not because they guessed the timing, but because they were positioned early. That's the essence of stage 2. You pay for protection when nobody thinks you need it.
Now look at today. Across 2024 and 2025, institutional hedging has increased in several areas. Analysts have noted elevated activity in put options, increased interest in VIX-linked trades, and rising costs to insure certain types of corporate and commercial real estate debt. This doesn't prove anything by itself, and not all hedging is predictive, but historically, early increases in protections often appear during stage 2, when sophisticated investors begin preparing quietly. To the average person, nothing looks wrong yet. The headlines are calm, the markets are high. But smart investors don't buy insurance after the fire starts. They buy it when the house still looks perfect from the outside. Stage 2 is that moment, quiet, subtle, and easy to miss. It's the part of the cycle where protection starts building, even while the surface still looks stable.
Stage 2 is where the smartest investors begin preparing quietly, not by panicking, but by buying protection long before the average person notices anything is wrong. In modern markets, protection usually means put options, volatility trades, or credit default swaps, tools designed to increase in value when uncertainty rises. They're not dramatic moves, they're insurance, and insurance is always purchased before the fire starts. This pattern has appeared before. In the years leading up to 2008, Michael Burry and John Paulson spent months paying premiums for credit default swaps on subprime mortgage bonds. For a long time, their trades looked like mistakes. The housing market kept rising. Their investors grew frustrated. But once defaults accelerated in 2007 and 2008, those hedges surged in value, and their patience paid off. They weren't lucky, they were early. And something similar happened again in early 2020 when investor Bill Ackman spent around $27 million on credit default swaps that acted as protection during the rapid COVID-19 sell-off. When markets fell, those hedges returned billions, giving him the cash to buy stocks at lower prices. That's the core of stage 2. You protect yourself while everything still looks calm. Now look at 2024 and 2025. Analysts have noted periods of elevated put option activity, increased interest in VIX-related hedges, and rising costs to insure certain types of corporate and commercial real estate debt. These movements don't predict a crash, and they don't guarantee an outcome, but they do reflect a shift in how some institutions are managing risk. To the average investor, everything still appears stable. Markets are strong, headlines are optimistic, confidence is high. But stage 2 isn't about fear, it's about preparation. The quiet kind that happens when sophisticated investors start feeling uncomfortable with the amount of risk in the system. They don't wait for the storm. They buy the umbrella long before the sky turns dark. That's the essence of stage 2. And in several corners of today's market, you can already see the early signs.
Stage 3 is where the strategy becomes aggressive. It's no longer about quietly exiting or buying insurance. It's about identifying exactly which parts of the system are most vulnerable and positioning before the weakness becomes obvious. You saw this clearly in 2008. Michael Burry didn't simply bet against the housing market. He analyzed loan-level data and targeted the specific mortgage bonds filled with the riskiest subprime loans. These were adjustable-rate mortgages that many borrowers could only afford at the teaser rate, concentrated in overheated markets like Florida, California, Arizona, and Nevada. When those loans began failing, many of those targeted bonds collapsed in value, and his credit default swaps surged. John Paulson followed a similar path. He didn't short everything. He focused on instruments tied directly to subprime exposure, and he also took positions against certain financial institutions he believed were deeply exposed to those failing mortgages.
When Bear Stearns imploded in early 2008 and Lehman Brothers collapsed that September, the value of his positions soared. Estimates suggest his funds generated tens of billions during the crisis. This wasn't luck, it was precision. Now look at 2025. The sector flashing the strongest early-stage stress is commercial real estate, especially office buildings in major U.S. cities, where vacancy rates have reached historically high levels. Many office towers were financed during years of low interest rates and now face refinancing at much higher costs. Some properties are struggling to cover debt payments, and analysts have raised concerns that certain loans may face difficulty as they mature. This matters because most of these commercial real estate loans sit on the balance sheets of regional banks.
Large banks hold some exposure, but regional banks often carry a much higher proportion of commercial property debt. When those loans weaken, these banks feel it first. We've already seen warnings. The failures of Silicon Valley Bank, Signature Bank, and First Republic in 2023 revealed how quickly confidence can evaporate when asset values and liquidity come under pressure. In 2024, additional stress emerged at other regional lenders with significant real estate exposure. None of this guarantees future failures, but it shows where the fragility is concentrated. Hedge funds aren't shorting the entire market. They're focusing on the parts of the system that appear most sensitive to higher rates and changing work patterns. Certain commercial real estate securities, banks heavily exposed to those properties, and debt instruments tied to struggling segments of the office market. This is the essence of Stage 3. Not panic, not predictions, just a calculated focus on where the pressure is building before everyone else sees the cracks.
Stage 4 is the moment everything flips. It's the part of the cycle most people never reach. Because when it arrives, the world feels like it's falling apart. Prices are collapsing, confidence is gone, and every headline warns of disaster. But historically, this is the stage where the investors who prepared early deploy capital, while everyone else freezes. You saw this in 1929. After the market fell nearly 90% from its peak, the few with cash bought assets at prices that look impossible just a few years earlier. Joseph Kennedy, for example, expanded his holdings during the Depression, purchasing distressed businesses, real estate, and deeply undervalued stocks. Those moves helped transform his wealth and set the foundation for the Kennedy family fortune. You saw the pattern again in 2008-2009. As panic peaked, Warren Buffett struck deals with major companies that needed capital fast. In 2008, he invested billions in preferred shares from firms like Goldman Sachs, terms structured with generous dividends plus options to buy stock in the future. As markets recovered over the next decade, those deals generated enormous returns. And because Buffett had cash when almost nobody else did, he could negotiate from a position of strength.
A similar dynamic appeared in early 2020. When markets fell sharply during the COVID-19 shock, investors who had hedged early suddenly had the liquidity to buy high-quality companies at discounted prices. Those who acted during the panic benefited from the rapid recovery that followed. This is the essence of Stage 4. When fear is highest, prices disconnect from fundamentals. Good companies get sold with bad ones. Assets that were unreachable a year earlier suddenly become affordable. Now look at the present. Across 2024 and 2025, some of the world's most sophisticated investors and private equity firms have raised large amounts of capital, often referred to as dry powder, designed specifically for moments when valuations fall sharply. These firms aren't preparing for today's prices. They're preparing for the prices that appear when panic enters the market. If economic stress deepens, whether through commercial real estate challenges, tighter financial conditions, or broader uncertainty, buyers with liquidity may be positioned to acquire assets at significant discounts. Not because they predict the exact timing, but because they understand the cycle. Markets overshoot on the way up, and they overshoot on the way down. Most people cannot act during Stage 4.
The emotional pressure is too strong. Fear takes over. Most people won't prepare. Most won't see the next stage until it's too late. If you want to stay ahead, subscribe. We're just getting started. But historically, the investors who maintained cash, prepared early, and followed the 4-stage framework have been the ones who took advantage of prices nobody thought they'd ever see again. Stage 1 is quiet. Stage 2 is preparation. Stage 3 is precision. Stage 4 is courage. This final stage doesn't reward timing, it rewards readiness.